Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's a former hedge fund manager, long only, picking out winning stocks from the bottom up. He currently has a global macro investing newsletter, also with winning stock picks from the bottom up. Gary Brode of Deep Knowledge Investing. Thank you for joining me again.
Hey, Jason. Thanks for having me. Great to be back.
So, Gary, we're recording this interview on Thursday, August 15th, 2024. The gold price, it's still very, very high compared to October, November. It's rallied over $500 an ounce. It has corrected a little bit. I think it touched 2,500 a few days ago, and then it touched 2,500 again today. It's at 2,454, a little bit of a correction today. The 10-year US Treasury yield, though, it started to dive. It's down to 3.92%. I want to get your thoughts on past cycles with a drop in the 10-year US Treasury yield. Do you think the market is starting to go risk off and that people are like taking profits on the Mag 7 and NVIDIA now?
Well, so they certainly were a couple of weeks ago. And then, I was reading something like the market's added $4 trillion in market cap. NVIDIA came back with they lost $1 trillion of market cap and added 700 billion back. I mean, it's one of those things where your answer to that question is going to kind of depend on the day. I think you bringing up gold and the decline in the 10-year yield is really interesting. Certainly, if rates come down, and the market thinks they will, and we have a resurgence of inflation, but with a lower yield on the dollar, that's going to be positive for gold. The two other things I see going on with gold are, one, there's a supply and demand imbalance. The supply of gold increases by roughly 1.5, maybe 2% a year, sometimes a little more. But India and China and a lot of individuals are just buying huge amounts of gold right now. The reason I have a fairly large gold position isn't so much that I have an opinion on gold. It's more that I have an opinion on the US dollar. And so with, 35, $36 trillion of nominal debt and another $200 trillion of off balance sheet liabilities, things like Social Security, Medicare, Medicaid, pensions, the Affordable Care Act, things like that. And then on top of all of that debt, Congress is still overspending by somewhere in the neighborhood of $3 trillion a year. And that's going to get worse because nobody's planning on cutting spending, but the interest expense is going, it's going up at an exponential rate at this point. All of those things mean there's going to be more future dollar printing, more inflation. And, one of the things that I've been doing to try to unravel the idea of inflation for an audience is to start to think about inflation as the loss of purchasing power of the dollars in your bank account or the dollars you're going to receive, in your next paycheck or your paycheck a year from now. And, once you start thinking about all of that, you realize that the dollar is being intentionally debased. That means losing purchasing power. And that's not going to slow down. And so what do? Right? Sell dollars and buy hard assets, things like gold or Bitcoin or energy. These are all things you and I have talked about before. But, what you're hitting on and the decline in yield on the US 10-year all fit into why I have such a large gold position right now.
Well, also the narrative today, I think the consumer price index, it either came out yesterday or the day or today. I can't remember if it was yesterday or the day before. Since I've been watching business news the last couple of days, it's all the same nonsense, though. It's that the Fed has inflation tame. The consumer price index is below 3% now. And so now these central banks, they have their official inflation rate tamed because I think in Europe, the official inflation rate is 1%. They're going to start cutting rates. You have a very interesting tweet, though. I was just looking up your Twitter account, and it brought this one up from July 10th, 2023. I'm going to read it for our listeners here. So many think 2% inflation is fine. And this is where the official consumer price index, or as I'm calling it, the CPI or changing propaganda index, is saying that inflation is headed. Here's what I'd love everyone to understand. In a 40-year working life, 2% inflation destroys 55% of the value of your money in purchasing power. 4% is 79% loss. 6% is 90% destruction. So that's the rule of 72, right?
Yeah, in this case, yeah, it's compounding. I just did the math. If you do the back of the envelope rule of 72, you get really close on this stuff. But, one of the reasons inflation is so insidious is one, most of the population can't figure out where it's coming from. And when Congress blames, greedy corporations or Vladimir Putin or, oil prices or They or COVID or
Those evil grocery stores now. That's the new narrative, right? It's like the evil
right.
but
Yeah.
anyone who has run a grocery store or convenience store at a gas station knows those are not very great businesses normally with their profit margins and the cost of capital to run the business, the capex, capital expenditure required.
That's exactly right. And they're very low margin businesses. It's hard to make a ton of money doing that. So Jason, you're completely right about that. But the point that I was trying to make to people is, people see 2% inflation as really like no big deal. Okay, so the thing that cost you $1 last year costs you $1.02 this year. Come on, why do you care? Why does it matter? And the answer is because it compounds over time. Because 2% over 40 years will steal more than half the purchasing power of your money. And that's a pretty normal working life for people to, be productive from like 25 to 65 or, 20 to 60. This is, 40, 50 years is about how long people tend to work. And, the amazing thing is, yesterday's CPI that came out, it was 2.9%. I think the core was 3.2%. So, right around 3%. And you're correct, Jason. There were tons and tons of headlines. Oh, we've won the war against inflation. The Fed has it under control. Do they? Because
I don't think
because
so.
yeah, one, 3% is not 2%. That there is a difference, and people are like, oh, come on, close enough. No, it's not close enough because when you start compounding this again over a 40-year working life, you go from what was it? We were 55% loss at 2% and 79% loss at 3%. So, somewhere, sorry, 4%. So somewhere, you're losing 65-70% of the value of your money at a 3% inflation rate over a 40-year working period. That's meaningful. That is a gigantic amount of intergenerational theft here. And on top of all of that, and I don't know why this is so controversial, but it is. I think that 2% target is 2% too high. The Fed's official mandate is stable prices. Stable prices means 0% inflation. And there are a lot of people who love to say, but without inflation, you'd have no economic growth because nobody would buy anything. Okay, first of all, when you have stable currency, when you have a reliable currency, people are comfortable investing for the long term. That's where economic growth comes from. When you have inflation, instead of investing, people think, oh no, I better spend today because tomorrow my money will be worth less. And that encourages people to consume and not invest. And that kills GDP growth. And so there's just this huge misunderstanding over what these policies actually mean. The other thing is this idea that, well, if inflation were zero, nobody would buy anything is complete and total nonsense. For the people listening to this, I want you to think about what you spend most of your money on in a month. I'm going to guess for most of the people listening to this, your biggest expense is going to be your rent or your mortgage. So what? You're not going to have a place to live because housing might be cheaper next year? No. You're not going to buy any clothing. You won't have a coat for winter because it'll be cheaper next year. Well, if you need a winter coat, you need a winter coat. People pay a lot for childcare and education for their kids and all kinds of experiences for the kids. So what are you going to do? Tell your 5-year-old, yeah, listen, we're going to stay home because these programs will be cheaper when you're 6. Your car, people, right? I mean, people, their second biggest payment after their rent or their mortgage is typically their car payment. So what are you going to do? So I'm going to walk to work. Well, not if you live an hour away. You're not to put gas in your car. So what I would suggest is that, if you really look at how much you spend in a month, I think for most Americans, somewhere in the neighborhood of 80 to 90% of purchases, food, obviously, nobody's delaying food prices because it might be cheaper in a year. You have to eat today or this week. I think for most American families, 80 to 90% of spending is not really discretionary or delayable, can't be delayed. And so this idea that, well, if we had zero inflation, nobody would buy anything is complete and total nonsense. And if you really want to have economic growth, you get that with a stable currency that encourages people to invest more, to prepare for the future, to build something and consume less today. And that's not a bad place for a society to be. So my whole point on all of this, cutting to the end of it, Jason, is the target rate for inflation should be zero. The Fed making it 2% is theft. For people to say, well, 3%, we've won under what that's, that's like having a running back get out in the open, on the football field, and he goes from his, goal line to the other team's 5 yard line. And at the 5 yard line, he runs out of bounds and screams touchdown. Like you don't get points for not crossing the goal line. 3% is not the goal, and the goal is still too high.
Well, I would argue the real inflation rate is still above 3% for a lot of consumer items. We're seeing that hidden in the data with insurance costs, food, many other things. But at 3%, Gary, rule of 72, 24 years from now, your purchasing power is going to be cut in half, even at a 3% inflation rate. I would argue that the real inflation rate has been above 2% for decades now, at least since the 1990s, because of DC spending.
I completely agree with you. And, for people who get a little confused about this or who don't follow these numbers as closely as you do, Jason, there are a lot of ways that they can skew these numbers. First of all, there are all kinds of adjustments. Those adjustments kind of take place behind the curtain, and you're just sort of supposed to expect it'll all be fine. They do things like, hedonistic adjustments, which sounds salacious, but it's not. It's basically saying, well, your car got better. So, we're going to compare it to the $15,000 car that, you would have bought 20 years ago, except that car now might cost you $45,000. And they're saying, well, you haven't really had inflation because the car got better, except you don't have the choice to go buy that $15,000 car with roll up windows and no air conditioning.
So it doesn't reflect reality, because if you're buying a pickup truck, a pickup truck like a Ford F-150 10, 15 years ago used to be like 35, 40,000 for a base model. And now, like, I think the base model, I heard in the last couple of years, it was like $75,000, $80,000 or something. It was insanely higher compared to the past.
I think that's accurate. And so the whole point of this is the Bureau of Labor Statistics that compiles the CPI, or the CPI, as you like to call it. They'll say, but the pickup truck today is much better. So we're giving this, they call it a hedonic adjustment. You get more pleasure from the better pickup truck. And so, it's not really more expensive, except instead of paying the $30,000 sticker price, you now have to pay the $75,000 sticker price, and you don't have the option to go buy the $30,000 model that, didn't have all the bells and whistles and the navigation system and might have had, a cassette deck instead of an entertainment system. Okay. But if you don't have that option, your life just got a whole lot more expensive. The largest place where the BLS, the Bureau of Labor Statistics, skews the inflation statistics is in something called OER, and that stands for owner's equivalent rent. And we've taken a look at this, we've run charts on it, but if you look at actual prices, you can look at like the Zori index, the Zillow observed rent index, or you can look at the Case-Shiller. These indexes reflect what Americans are actually paying for shelter or housing. And it's much, much higher than OER. Owner's equivalent rent is when they go to people who own their homes and they say, well, if you were to rent out your home, how much would you get for it? And they've never rented out their home. They don't know what the market is. Nobody's thought about it. And it hugely lags. And shelter or housing is the largest part of the consumer price index. And so as a result, you end up with a number that doesn't reflect reality. And so, Jason, I completely agree with your point. They can say, inflation in the US is 3%. But the truth is, for most American families, they're experiencing something much higher than that. Another place where I'm pretty sure they're playing with the numbers is in the food indexes. They keep telling us that your food costs at the supermarket are up only 1 or 2% year over year. I keep challenging people. If your grocery bill is up only 1% or 2% in the last year, I would love to hear from you, because you would be the first person responding affirmatively to that. It's just a huge problem. And, one thing I found fascinating is earlier this week, Vice President Harris came out and she said if she became president, she would cap food prices. And that's her giveaway. Now, first of all, that's terrible economic policy. Capping prices just ends up with shortages in black markets, and everybody ends up paying more. It doesn't work. And we have tons and tons and tons of real world examples that price controls don't work. But here's my question. if food inflation is only 1% or 2%, why do we need a price cap? So
Bingo.
something isn't holding
Bingo. So
together.
those two, exactly, those two things do not jive together. That's exactly. There's a lot of mishmash policies that the two things together make no sense.
Hmm. Exactly. I completely agree with that.
Yeah, so food prices are going up 1%. Why do you need to put in price controls? It makes no sense. Why are you bringing in Walls as a vice president? That's part of his policy stances is he's been promising poor people in exchange for their vote a bunch of food subsidies and guaranteed food. So similar to kind of what Bernie Sanders' policy. I view Walls as kind of a bad copy of Bernie Sanders.
Yeah, so these are Jason, these are terrible policies. And one thing I want to be clear on is I don't think I look, those particular bad policies are bad democratic policies. With that said, I don't think bad economic policy belongs to Team Blue or Team Red. I think it's very clear that whoever wins the November election, whether we're talking about the White House or either House of Congress, I think we should understand that nobody is planning on cutting spending. And at the end of the day, the number one reason why we're experiencing so much inflation is it's not the Federal Reserve this time around. It is overspending out of Congress. That is a bipartisan problem. And there is nobody you're going to be able to vote for in November, whether it's on the presidential ticket or in the Senate or in the House, that's actually planning on going in and being effective at cutting spending. So,
Oh,
you
I
know,
100% agree. Yeah. And
yeah.
then they're not even accounting in the CBO for the higher interest payments on the national debt, which are over $1 trillion. They're not even adding that in. And we're still projected, I think, over 8 trillion in US federal government spending for fiscal 2025. That's an insanely large number.
Actually, the where the numbers really get crazy, if you go out, I want to say, I forget the exact number. It was either like 2040 or 2050. Their projections were saying that the national debt would be something like, $50 trillion, which, hey, that sounds great, except here's the problem. They were assuming that we go something like a quarter century without a recession, or maybe it was 15 years. I don't remember the exact number, but that's how bad these projections are. And people are making policy supposedly based on economic projections. But, Jason, if you and I were economists, would we do 10 or 15 or 25-year projections for an economy the size of the United States and say, yeah, and by the way, we'll never have a bad year or two. We'll never have a down year. We'll never have two bad quarters in a row. Like if on Wall Street you did financial projections for a company like that, you like people would think you were completely crazy. That doesn't
It,
work.
you get fired. They laugh at you saying that it doesn't reflect reality. But if you're a PhD economist working for the government for the Bureau of Labor Statistics and you have someone in Congress or the White House, it doesn't matter which party, whichever party's in power, I guess, in the White House or Congress, putting pressure on you, you have to make the jobs reports look good for the November elections for Congress or for the White House. You have to make the inflation number look lower than expected. I mean, we had in the last 12 months, we had Chairman Jerome Powell a couple months ago. He actually called out the Bureau of Labor Statistics for the jobs reports, all the revisions. I was shocked that he said that in public, that he called them out.
I think that's a great point. And as critical as I've been of Chairman Powell, one place where I would love to give him a round of applause is he's called out Congress a couple of times recently on their overspending and just said this is not sustainable. Because I think he realizes people are looking to him as the guy who's responsible for taming inflation. And what he's correctly realizing is the Fed is caught. There's nothing they're going to be able to do to get inflation under control when Congress is overspending. I mean, we're throwing another $1 trillion of debt in every 100 days or so. So call it another, $3 trillion a year. That Powell can't control that. And he's called them out on that a couple of times recently. And, I give him a round of applause for doing that because he's one of the few people in Washington who's recently told the truth in public. And that, for that alone, I'm impressed and glad he's doing it. The problem is exactly nobody in Congress is willing to pay attention to that. And they're going to keep overspending. Now, one of the things that I always say is, it sounds like I'm negative and, depressed and whatever. But the fact is, I'm merely observing that this is the way things are, and this is what's going to happen next year and the year after and the year after that. And so if you know that, there's no point in getting upset. There's no point in waking up angry or unhappy or moping through the day. Understand that more inflation is coming. And as investors, we can position our portfolios to A, not get hurt by it, or B, even benefit from it. So, rather than be upset by it, and as an American, I am, but as an investor, my thought is, okay, well, we just need to position ourselves so that when you get more inflation, we make money from it. And that's it, because it's a whole lot, but doing something is better than complaining.
Before we talk about which companies or sectors you think are in the driver's seat for the way you see things shaping up with congressional spending and inflation or fiat currency destruction from all these political parties and governments and central banks, I want to get your thoughts on the yen carry trade unwind, because you've been writing about it in your newsletter for 12 months now, I want to say at least, and you've been warning that this could cause a lot of risk to the global economy. Are we starting to see a large scale yen carry trade unwind right now, or do you think it's kind of small scale right now?
So a small now, and I think it will get larger. And by the way, thank you so much for pointing this out. We actually started talking about the issues with the yen and the carry trade in October of 22, almost 2 years ago. We gave people fair warning on that. And basically what happened was the Japanese government, in a desperate attempt to stimulate their economy, took their rates actually to negative for almost a decade, and they spent an enormous amount of money. And what they did was they found themselves with negative interest rates and debt to GDP of about 260%, which is back of the envelope about double what we have here in the US, which is enormous. And so when the yield on your currency is low, your currency drops. It becomes worth less. And what was happening is people were putting on what's called the carry trade. So what they would do is they would sell the yen and short the Japanese government bonds. And doing so would only cost them a tiny bit of money because the yield on Japanese government bonds was artificially low. And then what they would do is they would buy dollars and use those dollars to buy US Treasuries, which would be yielding often 300 or 400 basis points more. And as long as the currency pairs trade didn't move too much, you have this guaranteed income, and they could leverage it up. And nobody knows the exact size of the carry trade, but it's reputed to be in the, tens of trillions of dollars. That's a big number. So as people were selling the yen and buying the yen slid against the dollar. And 2 years ago, it was $1 would buy you 102 yen. And as recently as about a month ago, $1 would buy you 162 yen. So ballpark, that's about a 60% loss in the value of the Japanese currency against the dollar, which is a real problem for a small island nation without a lot of natural resources that has to import energy, which gets priced in US dollars. So what happened was the Japanese government earlier this year said, we're going to get rates above zero. And, the market laughed at them because their version of getting it above zero was to change the reference rate to a range of 0 to 0.1%. So for an average of 0.05%, if everybody remembers a couple of years ago when you were earning like 0.0 something percent in your checking account and how annoying it was, like you'd get your statement and, your bank would tell you you'd earn 3 cents or something.
Is that 10 basis points or?
Yeah, it was an average of 5 basis points is where they were. And the currency just did nothing on that. But then a couple of weeks ago, over the weekend, they raised to 25 basis points. So a total of 0.35% at some point this year. And it was happening at the same time that the market was deciding that the Federal Reserve was 100% likely to cut rates in the US in September. And that combination caused, one, the yield differential to be reduced, which made putting on the carry trade less attractive. But more importantly, as people started to reverse that carry trade, they were selling dollars and buying yen. And that took the yen from 162 on the dollar to, I don't know the exact number, it was something in the 140s. And the issue with that is for the people who'd put on the carry trade, it meant that the thing that they were short, the yen, was rising in value very, very quickly. And the thing that they were long, the dollar, was falling in value. And that's not good when you have a leverage position that depends on just a couple hundred basis points of a yield spread. And so what ended up happening was people started to unwind this. And so then they're selling dollars, buying yen, selling US Treasuries, buying Japanese government bonds. And people who had done this, where they had used the money from shorting the yen to buy, say, US tech stocks, well, guess what we saw? Right? We saw something like a couple $1 trillion of money flowing out of the Magnificent Seven alone. And that's where that carnage was coming from. And so, what we got was just a tiny, tiny taste of what it looks like when that carry trade starts to unwind. That was just kind of like the mini preview, Jason. I think, this
Would you call that a margin call? Is that more or less a margin call then?
Yeah, so that's a great point. Part of what happens in these situations is they become dynamic or, as George Soros used to say, reflexive. And all that means is that as people were selling dollars and buying the yen, that would weaken the dollar and strengthen the yen. And that made other people who had the carry trade on that made their trades less profitable. And so their brokers would go to them and say, hey, you have this position and you're on margin and you're losing a lot of money and you owe us money. You have two choices. Either give us a ton of money that we're now going to hold against your losses and keep your position, fingers crossed that you'll make money in it tomorrow or next week or next month. Or alternatively, you can start selling this position. And so it's one of those weird situations where selling causes other selling. As the yen strengthened and the dollar weakened, these other participants in the carry trade started to get margin calls and they were forced out of their positions. And so they bought dollars and sold yen. Sorry, I said that exactly wrong. They sold dollars and bought yen. And that caused, the yen to move more against the dollar. And that caused the next group of people to have to unwind the carry trade.
Okay,
So
so
it
it's a
really,
feedback loop. It's George Soros
exactly.
calls it reflexivity, but it's a feedback loop. It starts to feed on itself. But these margin calls, Gary, they could be what Nvidia shares or Mag 7 tech stocks or Apple stock or gold. People are selling whatever they can at a profit, right, to pay off the margin debt.
Yeah, and that's part of it as well. And you know what? It even gets to Bitcoin in a really important way. So technically, the carry trade refers to that, long U.S. Treasury, short Japanese government bonds. But certainly, some people were buying U.S. tech stocks with that money. Technically, that's not the carry trade, but it's, a close cousin. The other thing is when they had losses, they had to sell something. And they had these very highly valued mega cap tech stocks that are ultra liquid. Of course, those got sold. And one of the reasons why, when this stuff happens, Bitcoin gets hammered is because it trades 24 hours a day, 7 days a week. And so when this news comes out like over a weekend, what can you sell? You can't sell Nvidia on a Saturday. You can't sell Microsoft on Sunday. You can't sell Google at 4 a.m. on Monday. I mean, you can, but there's not a ton of liquidity in there. But you could sell Bitcoin over the weekend. You could sell it at 3 a.m. And so some of what's going on is simply a massive grab for emergency liquidity to stave off a margin call. And then, what the way you described it as a feedback loop is exactly right. The more this happens, the more pressure there is on people's portfolios. People start to blow out um, their risk controls, their risk limits. And when that happens, they're no longer allowed to use their judgment and say this is temporary or this company's worth more. Once you've blown through your risk limits, people end up selling positions on a non-discretionary basis. It doesn't matter if you're right or wrong, you're selling and you're selling now. And, compliance and risk control are basically in your office saying, sell it or we fire you and sell it for you.
Exactly. And the feedback loop and the margin calls also feed into the VIX spike. So a lot of people aren't aware of this, that a large volatility move in the stock market index or the tech stocks and stuff starts to cause a VIX spike because you had the VIX capped. It's an income product for a lot of institutional investors that they just sell volatility, and that's why the VIX doesn't move. Because I get questions all the time, why doesn't the VIX move? Because a lot of institutional investors literally sell volatility, so you don't have the VIX move a lot. And then when it does, because it's so over leveraged, it's over 3 trillion in size as an income product. A lot of professional money managers bet the VIX won't move. When it does move, it starts to blow stuff up and cause that feedback loop volatility. So it sounds like you had the yen carry trade unwind and the margin calls start to spill then into the leverage short volatility too. And then the two things started to feed on each other. And that's how you got the VIX spike to 66 and then panic.
Jason, I think that's a great, really concise explanation you gave there. Um, and there's an old expression for people who are investing in the way that you were just describing. It's called picking up nickels in front of a steamroller, right? It for a long time, it looks like free money. And you're not collecting a ton of money. Like, being short the VIX, nobody got rich doing that, but it was free money. You pick up a nickel here, pick up a nickel there, sort of this steady profit because volatility tends to not do a whole lot. But then it does exactly what you said, right? When it spikes from, 15 to 65 overnight, that's when,
Wipes out hedge funds. It could wipe out a hedge fund. It could wipe out a portfolio manager at a bank. We saw that one in 2019 with Volmageddon.
Yeah, and by the way, I was long volatility when that happened. That night, I mean, I remember I was actually on the treadmill that night and watching the stuff melt down and literally watching funds go out of business. And we were long volatility, simply on the thesis that we were talking about. It was picking up nickels in front of a steamroller. And so, it's free money until like the edge of your pant leg gets caught by that steamroller, and then you're stuck and you just get flattened. And people would get flattened and go out of business. It's great until it doesn't work, but when it doesn't work, you don't get a warning. You don't get time to react. It's just like things are great, oh no, we're out of business. And that's why those strategies are so dangerous. And that's why these firms, they operate with very tight risk limits, but the risk limits don't matter if you gap from 15 to 65 on the thing that you're short, right? There's often
Or the
no
yen moves, yeah, and then the carry trade, like the margin calls are massive.
like exactly when the yen goes from 162 to 145 in a day, it doesn't hang out at like 160 and 158 for hours and hours and hours while you figure out what's going on. These moves happen really, really fast. They go all at once. And by the time you know about it, it's often too late. And at that point, your pants leg is caught by the steamroller and you're just waiting to be run over and be put out of business.
So do you think then this yen carry trade that the problems are just starting for the lenders and the borrowers? So these Japanese banks, we saw this a little over a month ago at Nordschuken Bank, and the mainstream financial media tried to play this off that like, oh, their losses on US Treasuries only went from 3 billion to 10 billion. But a lot of these Japanese banks, Gary, weren't they lenders to these hedge funds and portfolio managers of banks in the US and Europe for the yen carry trade? So they have to have massive exposure there too.
I'm sure some of them were. And, just so I'm straightforward with you and your audience, I haven't made a study of, what I think the exposures are at these Japanese banks. But I think the idea that those losses are only in US financial institutions is not realistic. I think your view that some of them had to be lenders to people putting on the carry trade, it has to be true. I'm certain that's the case, but I can't tell you who, and I'm not in a position to prove it. It just what you're saying intuitively
I'm
makes
not even
sense to
sure
me.
all the disclosures for the Japanese banks are in English.
Yeah, I know. I am unfortunately not able to read their beautiful language. So yeah, I don't know exactly, but I think it's realistic to assume that there's a lot of risk on both sides. The other thing is, um, people often underestimate the amount of leverage in the system. And so, what the numbers that you just gave was only, a few $1 billion of losses or, $1 trillion of losses, whatever it is. But that can be a multiple of a bank's equity. It can be a multiple of what they have um, on their balance sheet. And, even if we go back like a year and a half here in the US when we had, four of our largest banks fail all in one month, it wasn't necessarily that the amount of money lost was so enormous. It's that it was enormous relative to the actual size of their balance sheet because they'd taken on so much leverage. So on a percentage basis, the losses might not have been huge, but on a dollar basis, it just wiped out all of their equity. And that's the danger of being leveraged. And again, these are situations where once they start to go, they can go all at once. These institutions are fine until they're not, and when they're not, they're just done. And they needed to have acted months earlier. And by the time they figured out they needed to do something or were willing to face the problem, it was just too late.
And that's why I think it's concerning that Warren Buffett has sold so many shares of his Bank of America position so quickly. I mean, he must know something that the rest of us do not yet. I know Bank of America wrote down over $100 billion of losses in US Treasury bonds over the last 12 to 18 months, but the market didn't seem to care at the time. Well, maybe now those chickens are coming home to roost, or they have other problems with their commercial real estate portfolio or something. It's just interesting that Buffett would decide to sell so many shares of that bank stock so quickly.
So you know what, Jason? I think, you have followed that story and that analysis more closely than I have. And I think, Warren Buffett has followed it much more closely than both of us put together. Um, but I suspect that the second thing that you said would be the truth, that it's some other exposure. And the reason I think that is because with yields in the US coming down, and they are, that would increase the value of these banks' bond portfolios. And that, by the way, is where the most leverage is. And so, you know, basically, if they were underwater on their bond portfolio, but they were able to hold, they're now starting to make some of that money back. So, to the extent that there is a problem, or if there is a problem, and I haven't analyzed it, I can't tell you if there is or isn't. But I suspect is what you said, that the exposure is probably coming from someplace else.
I want to get your thoughts on the Bank of Japan. So you said they really can't raise interest rates because what 100 basis points or 1% increase in interest rates in Japan, the interest payments on the Japanese debt would just be enormously burdensome. Why do you think they're not adding gold tonnage? Because in past history, when a country or a central bank wanted to defend their currency, they would accumulate gold tonnage, what with their trade surpluses. It just seems like a no-brainer that Japan, if they want to defend their currency, should start buying physical gold with their trade surpluses.
So, Jason, I don't think the issue here is that they need dry powder to defend their currency. The Bank of Japan has ample foreign exchange reserves. They have dollars and euros and pound sterling. They have foreign exchange reserves, but it's not helping them. And so, what we've seen is there have been at least three instances in the last year when the Bank of Japan has thrown tens of billions of dollars at defending the yen. And I think, the total money they've spent on this, the total foreign exchange reserves they burned through doing that is somewhere north of $100 billion. That's real money. And what we've typically seen is that defense, what they do is they sell the foreign exchange reserves they own, and then they buy their own currency. They buy the yen. And that will work for somewhere in the neighborhood of 24 to 48 hours. Basically, they have enough muscle to push the market around, and they do it. But 24 to 48 hours later, what they haven't done is they haven't addressed the root cause of the problem. And in this case, what's causing the problem, the structural issue, is that they've kept their interest rates so low. And that's what's causing their currency to slide. And so whether they have gold or dollars or Bitcoin or euros, until they address the underlying structural problem, it won't matter. At least I don't think it will. And the problem is exactly what you said. At 260% debt to GDP, if they raise rates to anything reasonable, I mean, we're at what, 5.3% here in the US right now. That they can't go anywhere near that because their debt is so high. And what will end up happening is their interest expense will go up and it'll blow out their budget. And the only response to that is they'll have to print more yen to pay the interest. And printing more yen will cause more inflation, which another way of saying we have inflation is saying the purchasing power of our currency is declining. That's the problem they're trying to avoid. And, before anybody thinks that, I'm smug about pointing out issues in Japan, one thing that worries me is we have the exact same problem here in the US. And it's something, I wrote an ebook on this last year called Counterintuitive Inflation, basically saying, people want the Federal Reserve to lower rates, but if they do, you end up with more inflation for all the reasons we were just talking about with Japan. But, if they were to raise interest rates to try to get inflation under control, well, the only way we can deal with that is to cut spending. Well, that won't happen. And so we'll end up printing more dollars. And when that's done, uh, an increase in the money supply is the definition of inflation, or in our case, lower purchasing power. It's something that someone I respect a lot is Lynn Alden. She's referred to that exact same phenomenon as fiscal dominance, basically saying Congress is spending so much money that no matter what the Fed does, we're going to end up with more inflation either way. And you really need to have fiscal control of the situation as opposed to monetary control. And so, she's talked about it as fiscal dominance. I wrote about it as counterintuitive inflation. These are all problems we're going to have to deal with here in the US. So, please, everybody, view what's happening in Japan right now as an early warning. The problems they have, we should not feel smug about it. We should look at that and say, oh no, we're heading in that direction. And we're already at the point where we're at fiscal dominance. And so I think the Bank of Japan is trapped. If they keep rates low, the currency slides and they have inflation. If they raise rates, their interest expense goes up, they print more yen, that causes inflation. They have a problem either way, and we're really at the same point ourselves.
And I would argue that actually the budget deficits, the pace, DC is actually going to surpass them at some point. Although they measure, they count government spending as beneficial towards GDP right now. And the U.S. has held the world reserve currency, so a lot of that monetary inflation, the dollars have been exported over the years. With Warren Buffett, I think even made a video on this, on how global trade actually works and how like a lot of dollars are just printed for goods and services that other countries produce because those other countries want to just earn dollars, and the U.S. doesn't produce a lot of actual goods and services in
Yeah,
trade.
our number one export is the dollar. And so, that's going to be a problem if at some point some of these people in other countries decide they don't want to own dollars anymore. When those dollars come back here to the US, they bid up the cost of assets. And you think we have inflation now. Try to imagine what happens when the appetite for the dollar decreases and the trillions of dollars held overseas start coming back at us. And bidding up asset prices. And, that will then be inflation. Like if you don't like your rent now, you really won't like it then.
Well, I think that's already happened to a certain extent. I think there's a lot of Chinese and foreign owners of a lot of single family homes and luxury condos and apartments and stuff in major cities and metro areas, and single family homes in a lot of markets like California and elsewhere. So that's been going on for a long time, that foreigners have been buying up our assets, specifically real estate and large cap tech stocks.
Yeah, I think when they were building some of these um apartments in Manhattan for billionaires and on Billionaires Row, some of these apartments were going for something like $95 million. And the stories I heard was it was a lot of Russian money coming in or Chinese money coming in. And I
There was,
remember one
yep,
time somebody asked me, how do you get financing for that? I said, no, no, no.
all cash, man.
Right. I said, this is their way of getting cash out of their countries. They don't want the mortgage. They want to get the cash out.
Yeah, here in DC metro area, I mean, my friend's firm used to handle some of those. They weren't like $95 million for a penthouse, but there would be Chinese couples or business people that would come in on a plane with some suitcases or wire transfer checks, and they'd buy a few things all cash. They weren't doing any mortgages or anything like that. So they'd spend a few $1 million, and then they'd be back on a plane somewhere to mainland China or Hong Kong within a couple days.
Is that legal to come into the US with millions of dollars in a suitcase? Don't you get stopped at customs and somebody say, what in the world's going on?
I have no idea. I mean, like on a private jet, people used to get away with the rich people, the billionaires on private jets, what they used to smuggle artwork, what they'd keep it at the airport. So there was all these loopholes. I mean, there was what no hardly any pre-checks or something like that on private jets for a long time, and people were smuggling artwork. They figured out a loophole, I think, for a long time that the artwork, if it stayed in the airport, it was a neutral zone. There was tax laws
So
about that all over Europe.
someone did a heist film about that. I can't remember what it was. It was a heist film based on the fact that as long as the artwork didn't leave the airport, it didn't become taxable. It wasn't transferred, and so they were keeping priceless artwork in the airport. and that was the scam. But it's really interesting.
Yeah, it doesn't surprise me. I mean, rich people, really, really rich people, they can hire tax attorneys and tax accountants. They can figure out all the loopholes. They can set up trusts so they can move their personal assets into trust so they're not sued. So there's all those different types of things. But as we wrap up here, Gary, though, I want to ask you about sectors and industries that will benefit from the spending policies from both political parties. And honestly, I think it doesn't really matter who's in the White House at this point or who's controlling Congress, because I don't see either political party wanting to actually cut spending. Maybe one of the parties increases taxes more directly, and the other one, instead of raising taxes directly, they do some type of targeted tax cut. But then you're dealing with a loss of purchasing power with increased government spending. Which industries do you think will benefit the most from both political parties in DC just continuing spending like this?
So that's a great question. There are three places where I've committed a lot of capital on this exact thesis. One is in hard assets. So as we were talking earlier, if we're going to have more and more spending, and that's going to be followed by more dollar printing or monetization of the debt, that will result in more inflation. So owning things like gold and Bitcoin, that's a great place to be. The second place where I'm investing on this is in energy, whether that's oil or uranium or oil field services. The fact is, most of the planet wants to live a more comfortable material quality of life, and that is almost 100% tied to energy usage. Energy demand for the on the planet is increasing, and so owning things like um, oil and uranium, because we're going to have a huge increase, I think, in nuclear plants being built. Those would be great places to, because those things get priced in dollars. So as the dollar loses purchasing power, the dollar price of those assets tends to go up. And so that's another good way to play it. And then finally, I've been investing a lot in the healthcare sector. Earlier this year, we made a lot of money in Shockwave Medical, which was a single product company that, we started buying it last December at 191 on the thesis that, it was a really high growth company. The thesis was they'd be acquired by Johnson and Johnson, Boston Scientific, or Medtronic. That actually happened 3.5 months later. We made more than 70% in under 4 months on that. And I've just found something working with the same physicians, and I have, doctors on my board of advisors, and working with those same people, we found a very similar situation. Another single product drug or device company, an insanely high growth rate, a better solution. I don't think anybody's going to cut healthcare spending. I think that's, not economically sensitive. Whether we're in a recession or not, people will still need this drug or device. Um, and so, and the other thing is it provides better patient outcomes, but saves the insurance companies or Medicare or Medicaid somewhere in the neighborhood of 75%. So if you can save the government or the insurance company money, make the patients more comfortable and give them a better quality of life and get the same medical results, that to me seems like a great place to be. They've already had products approved by the FDA. They're already selling. They're increasing their sales force. My subscribers already know what this idea is. We've been buying it. I was buying more of it this week. But they will have DKI subscribers will have the full write up on this, the full report. We'll have that out to them next week. So if people are interested in that, that sounds like something that you're interested in. Feel free, go to deepknowledgeinvesting.com, click the subscribe now button, and you'll be seeing the full report next week. I think this is the kind of thing where you could easily make 4 to 5 times your money over the next 3 to 5 years. And to me, one of the ways you can make a lot of money in the market is you find things that have similar characteristics to other things that have worked. This to me looks a lot like Shockwave, but with more upside.
Very interesting. I mean, healthcare people, that's part of their non-discretionary budgets with a lot of healthcare. So we're starting to see people cut back and trade down right now, but that seems to be one of the main staples, along with what people paying rent and mortgage payments. So healthcare and food are some of the main expenses that people have to pay pretty much no matter what.
Yeah, that's exactly right. And, for better or worse, the government is a huge percentage of healthcare spending. And so, for better or worse, that makes it very recession resistant. On top of the fact that, if you have a medical issue, that money tends to be spent whether you want to or not, because, there are certain things you can delay, a hip replacement or a knee replacement. You can live with that discomfort or pain for a while. Um, but certain things you don't have the luxury of waiting. If you need treatment, you need it now. And this company, most of the revenue comes from government sources, whether that's Medicare or Medicaid. A smaller part comes from private insurance. But either way, being in a position where you get identical medical outcomes, better patient safety, and lower costs to the payers, and in this case, the payer being the government, that's a pretty good place to be when you want to grow your revenue really quickly. And that's what's happening.
Last question before I let you go. What do you think is the probability that we see $3,000 an ounce gold in 18 months or less, given all the macro circumstances and how the central banks all seem to be wanting to cut rates? Either they've already started cutting or they're about to start cutting, like the Federal Reserve Bank, and they're claiming inflation's low, but it looks like they're going to start adding liquidity and starting monetary inflation again, or asset price inflation.
Given the amount of gold I own, I would love to see that. And certainly, I think we're going to see $3,000 gold this decade. No problem on that. 18 months might be a tight time frame. That's, ballpark of $500, $600 move from here. We did see that. We did see that earlier this decade and it happened pretty quickly. But that kind of move tends not to happen that often. So I don't know. The probability that you see that in 18 months, I'll say maybe 25, 30%. The probability that you see a move like that in the next 5 years, I would say is more like 80, 90%.
Okay, because we did have around $500 an ounce move in the gold price in US dollars. In other currencies, gold was already at or near an all-time high over the last couple of years, especially look at the gold price in Japanese yen, which I think is up over 150%, I think in the last 5 or 6 years. But gold prices in other currencies were at or near an all-time high before this last move in the US dollar gold price since October. We've had around a $500 an ounce move already.
Yeah, exactly. And so the question is, are things going to get worse quickly enough to get another, like the next $500 move in the next year and a half? And maybe, 30%, that's my estimate. That's not zero. That's a meaningful number. It's, 1 in 3. Um, I'm just noticing you tend not to see huge moves in gold that often. I think we'll see it this decade, but not as likely in a shorter time frame.
Well, I think we're seeing a paradigm shift in the supply and demand picture for gold and silver demand because from retail investors and the major marginal increase in the demand for gold and silver, it's retail investors in China, India, Japan, Korea, Thailand, Vietnam. We're seeing record purchases for gold and silver demand there really since October that we did not expect. So that has really surprised the market because everyone's talked, Gary, for the last 12 to 18 months about these non-G7 central banks that were dollar cost averaging gold tonnage each month because of the Russia sanctions. Well, here we are. This new marginal buyer has been out of Asia, and they've been buying massive amounts of coins and bars for retail investor and some jewelry demand out of China.
Yeah, I think it's really interesting. People have said this is going to be the Asian century. Maybe it will, maybe it won't, but I think they're showing a lot of confidence by buying huge amounts of gold. And in general, one of the ways throughout history that you gain a lot of power and strength for your currency and your economy is to own a lot of gold. So, if I were them, I'd be doing the same thing. And, one thing that really jumped out at me, Bitcoin conference a couple weeks ago, um, Robert Kennedy was talking about, the US having a Bitcoin strategic reserve. President Trump talked about holding on to Bitcoin that, the Justice Department had seized. Somebody else aligned with him came out and talked, about acquiring something like, somewhere between 1 million and 4 million Bitcoin. Um,
I
One
think
of the
the
things
US
that's
government already owns a lot. I think through confiscation, I think the US federal government already owns a lot of it.
Yeah, and they do. And the thought is that they show more. And one of the things that's amazing to me is given how worthless fiat currency is and how easy it is to produce more of it, it's not clear to me why the US government and other governments and central banks around the world aren't just printing huge amounts of fiat currency because they're already doing it and buying up gold, silver, uranium, copper, lithium, Bitcoin. Like this is an area I think the Chinese have done a lot of detrimental things to their own economy. I don't like their command um, top down model, but this is one area where I think they've got it right. And I've been a little surprised that Western governments haven't been eager to use the unjustified strength of their currencies to just print more of it and buy huge amounts of hard assets. And what's really interesting is the current administration in the White House sold down about as much of the SPR, the Strategic Petroleum Reserve, as they could. Um, but at the same time, pursuing hugely inflationary spending policies. Well, if you're going to do that, then you might as well keep printing and buy more oil. And yeah, I get it. They were trying to get prices down at the pump, but if we're going to act like our currency, either act like the currency has value or acknowledge it doesn't have value. And if it doesn't, print it and buy hard assets.
I think that would be better central planning, although I'm not in favor of any central planning. But I think the Chinese government has done that. I think they're lying about the money supply numbers. They claim that there's very little or no inflation in China. And I think they've been buying a lot of commodities. They have like 5 strategic petroleum reserves of oil. They've keep building warehouses and putting copper, nickel. Occasionally, they do sell some base metal back onto the market if they think the price is too high. But overall, I think like commodities historically, out of all the asset classes, they tend to perform the best in longer periods of inflation.
So, Jason, I'm completely with you. I'm not a fan of central planning either. I think it's a disaster. I'm just pointing out that if you're going to do stupid things with your money, then at least do smart things based on the stupid things. And it reminds me of an article I wrote a couple of years ago titled, We'd All Be Better Off If the Squirrel Who Lives in My Backyard Ran the Federal Reserve or were chairman of the Federal Reserve. Right. And this squirrel who he's a squirrel of unusual character, but completely normal size. I would watch him, on a weekend. He would spend 5 or 6 hours at a time. He would run up I have a stone wall and a fence on top of it. And he'd run up to the top and he'd run all the way along the top of the fence and then come down and then race up a tree, grab a nut in his mouth and then run down and then back across the fence and down the wall and he'd go hide it somewhere. And like here's the squirrel. He understood you need to save and save and save and save before you can start to consume. And I'm thinking, if anyone in Washington got to know this squirrel, they might see he's got a better plan than any of them do.
That sounds like a children's book there for teaching kids about how bad the Federal Reserve Bank is. Maybe someone in one of our, I know we have some artists, graphic designers and artists in the listener base here. Maybe they'll turn that into a children's book and you could collect some royalties.
Yeah, good. I want credit for a squirrel of unusual character but normal size.
Except I think if Janet Yellen was a squirrel, since she did run the Federal Reserve Bank for a while, I think she'd want the magic mushrooms though. So.
Oh my God. Yeah. But one of my all-time favorite Janet Yellen line, our friends at Unicus Research, Lex Ganapathy, once referred to her in writing as the Marie Antoinette of our inflation, which I thought was one of the most clever turns of phrase I'd ever heard in my life.
Well, her and her husband, because she was so divorced from reality about like inflation and grocery prices that I think her and her husband, they staged a photo op to go grocery shopping. But I think she only ended up buying mostly like stuff to mix alcoholic beverages with and like snacks for doing drugs like marijuana munchies and stuff.
Yeah, that reminds me of the God, this was so many years ago. It was like 30 years ago. Maybe it had to be more. It was more than 30 years ago. Do you remember when then President Bush he bought a pair of socks and like was surprised by the like the scanning device. I think the truth of it wasn't as bad as it seemed to be, but the way it got portrayed just made him seem very out of touch because, when would he have been in a store buying something himself?
Yeah, normally it's the maid or the butler. So the maid or the butler and the bills are paid so ahead of time or catering is hired. So they're not used to doing normal stuff that everyday Americans do that like noticing at the grocery store or Walmart or Target or Amazon or Costco, some of this other that there's shrinkflation on the food or the prices are up.
Yeah, well, we'll see. We'll see. We've gotten a promise out of Washington that they're going to cap food prices, and so everybody can now be assured food inflation is now conquered by degree.
Unless there's shortages, like you said, because this economics 101, you start putting wage and price controls in place, and the manufacturer of the goods starts deciding either we're gonna ahead of time make shrinkflation and produce less goods or a smaller portion, or there's not going to be any goods produced at all. People in Venezuela know this because I think not Maduro, Hugo Chavez first, then Maduro. I think they
Right.
put in what price controls at the supermarket, and then the supermarket started having almost no goods at all.
Yeah, it got so bad. It actually got to the point where, and pardon me for being a little indelicate about this, but this is actually true. It was cheaper to use their currency as toilet paper than to use the currency to buy toilet paper.
Yeah, I mean Venezuela has turned into a disaster, and then like immigration policy has brought a lot of that stuff here. So there's just a lot of bad policies. I don't want both political parties are a disaster. Honestly, they're writing research reports. I'll tell you this offline. They're talking about like Cold War 2.0 and how the military industrial complex here needs to spend trillions of dollars more to compete with China and Russia for military stuff. So they have like these PhD economists and the lobbyists and all the think tank people and the consultants. They're all combining their efforts into these research reports, trying to justify that the military budget needs to keep increasing going forward.
Wow.
Yep, this is a new normal here. This is how the grift occurs and why spending doesn't really stop.
Well, again, we have two options, right? We can either wake up unhappy and frustrated and dissatisfied and just be unhappy about it, or we can acknowledge that this is the way it's going to be. And so with that is going to come more inflation and just calmly find an investment strategy that will produce great returns in those circumstances.
Exactly. Exactly. Rather than just hoarding cash. So, if you go cash to the mattress and with those policies, you just hoard cash, long term, you're going to lose. Your cash is going to be debased. The purchasing power is going to be intentionally destroyed and taken.
Right. And by the way, this is why the squirrel portfolio is so effective. When the squirrel buries a nut and he goes back to get it, it's still one nut. He hasn't lost purchasing power.
It sounds almost like the royalty model. They're buying royalties on land for the commodity companies there, and then there's a discovery or something like that. So the royalty companies have done pretty well. Sounds almost like the squirrel's a royalty investor.
Yeah. There you go. Yeah. He's a quality investor, that squirrel.